China's real estate sector, once a symbol of the nation's economic prowess, experienced a seismic shift with the downfall of Evergrande, one of its largest property developers. This event marked a significant turning point in the country's economic narrative. This financial collapse, triggered by a toxic mix of excessive debt and waning demand, sent shockwaves throughout China and beyond. It exposed vulnerabilities in the global financial system and raised concerns about a potential worldwide economic slowdown, affecting markets and economies far removed from China. Evergrande's troubles became glaringly apparent in 2021, when the company, burdened by a staggering debt exceeding $300 billion, began defaulting on its financial obligations. This massive debt load was a result of years of aggressive borrowing to fund rapid expansion. This marked a turning point for China's property market, which had long been fueled by speculative investments and soaring property prices. The market's reliance on continuous growth and high demand was suddenly called into question. The once unthinkable scenario of a major player like Evergrande teetering on the brink of collapse shattered the illusion of invincibility that had surrounded the sector. Investors and developers alike were forced to confront the harsh realities of an overheated market. As Evergrande's crisis deepened, it became painfully clear that the company's woes were not an isolated incident, but rather a symptom of a much larger problem plaguing China's real estate market. A massive property bubble inflated by years of easy credit and speculative buying. The bubble's burst threatened to destabilize the entire sector. The Chinese government, wary of the potential systemic risks posed by a full-blown real estate crash, stepped in with a series of measures aimed at curbing speculation and reining in the sector's debt levels. These measures included tighter regulations and stricter lending practices. These measures, however, did little to alleviate the immediate pressure on Evergrande and other struggling developers, who found themselves grappling with mounting debts, stalled projects, and dwindling cash reserves. The short-term impact was severe, with many projects coming to a standstill. The Evergrande saga served as a wake-up call for investors worldwide, highlighting the interconnectedness of global financial markets and the potential for localized crises to reverberate across borders. It underscored the need for greater scrutiny and risk management in international investments. As the dust settled, it became evident that the fallout from Evergrande's collapse would extend far beyond China's borders, impacting investor sentiment, global financial markets, and even the lives of ordinary Chinese citizens. The long-term effects would be felt in various sectors, from construction to banking, and would shape economic policies for years to come. The Evergrande crisis acted as a catalyst, puncturing China's property bubble and exposing the fragility of a sector that had long been considered a cornerstone of the nation's economic growth. This crisis didn't just affect Evergrande, it sent shockwaves throughout the entire real estate market, revealing deep-seated vulnerabilities. With Evergrande's downfall, a wave of uncertainty swept through the Chinese real estate market, leading to a sharp decline in property prices, a slowdown in construction activity, and a crisis of confidence among home buyers and investors alike. The once unshakable belief in the ever-rising property market was now replaced with fear and hesitation. The once booming property market, which had attracted billions of dollars in investments from both domestic and foreign buyers, experienced a dramatic reversal of fortune. Investors who had previously seen real estate as a safe bet were now scrambling to reassess their portfolios. Property prices, which had been on an upward trajectory for years, began to plummet in major cities across China, leaving many homeowners facing the unsettling reality of negative equity. This sudden drop in property values meant that many people owed more on their mortgages than their homes were worth. The decline in property values had a ripple effect throughout the economy, impacting everything from consumer spending to government revenues. Retail shops saw fewer customers, and local governments, which relied heavily on land sales for revenue, faced significant shortfalls. As property prices tumbled, developers who had taken on massive debts to finance ambitious projects found themselves in a precarious position. Many of these developers had over-leveraged themselves, betting on continuous growth that never materialized. With the value of their assets plummeting and access to new financing drying up, many developers faced the prospect of defaulting on their loans, further exacerbating the crisis. Banks, too, were caught in the turmoil as the rising number of foreclosures threatened their balance sheets. Construction projects stalled across the country as developers struggled to stay afloat, leaving a trail of unfinished buildings and unpaid suppliers in their wake. The construction sector, which had been a major employer, saw widespread layoffs and financial distress. The Chinese government, faced with the daunting task of containing the fallout from the property market crash, implemented a series of measures aimed at stabilizing the sector and preventing a full-blown financial meltdown. These measures were crucial in preventing a broader economic crisis. These measures included providing financial assistance to struggling developers, tightening lending restrictions to curb speculation, and introducing policies to boost demand for housing. The government hoped that these steps would restore some level of confidence in the market. However, the road to recovery for China's real estate market promised to be long and arduous, with the scars of the Evergrande crisis likely to linger for years to come. The long-term economic impact was still uncertain, and the lessons learned from this crisis would shape the future of China's real estate policies. The reverberations of Evergrande's implosion were felt far beyond China's borders, sending tremors through the global financial system, shaking the very foundations of international finance, and raising concerns about a potential domino effect that could topple other debt-laden companies, creating a cascading series of financial failures, and trigger a worldwide economic downturn, affecting not just businesses but also the livelihoods of millions of people around the globe. The interconnected nature of global finance meant that Evergrande's woes were not simply a Chinese problem, but rather a stark reminder of the systemic risks that pervaded the global economy. The ripple effects were felt in stock exchanges from New York to London and from Tokyo to Sydney. International investors who had poured billions of dollars into Evergrande's bonds and other financial instruments faced the prospect of significant losses as the company's financial health deteriorated. The fear of losing their investments led to a sell-off in global markets. The potential for a disorderly collapse of Evergrande, with its vast web of creditors and suppliers, sent shockwaves through global credit markets, leading to a spike in borrowing costs for businesses worldwide. This sudden increase in borrowing costs made it more expensive for companies to finance their operations. This, in turn, raised concerns about a credit crunch that could stifle investment and economic growth, potentially leading to a prolonged period of economic stagnation. The Evergrande crisis also exposed the vulnerabilities of the global financial system to sudden shocks and the potential for contagion effects to spread rapidly across borders. The fragility of the system was laid bare for all to see. The interconnectedness of global banks, investment funds, and other financial institutions meant that a crisis in one part of the world could quickly escalate into a global problem, as investors became more risk-averse and withdrew capital from emerging markets. This withdrawal of capital could lead to financial instability in those markets. In response to the growing anxieties surrounding Evergrande's potential default, central banks around the world took steps to calm financial markets and prevent a wider panic. These measures included injecting liquidity into the markets and reassuring investors of their commitment to financial stability. However, the episode served as a stark reminder of the fragility of the global financial system and the need for greater regulation and oversight to mitigate systemic risks and prevent future crises. Policymakers and regulators were urged to take proactive steps to strengthen the resilience of the financial system. The Evergrande saga cast a long shadow over investor sentiment worldwide, fueling a climate of uncertainty and prompting a reassessment of risk in emerging markets, particularly those heavily exposed to China's real estate sector. The once bullish outlook for Chinese investments dimmed as the Evergrande crisis exposed the risks associated with the country's rapid economic growth and the opacity of its financial system. Investors, once eager to capitalize on China's booming economy, became more cautious, pulling back from real estate investments and other assets perceived as risky. The flow of foreign direct investment into China slowed as investors adopted a wait-and-see approach, seeking greater clarity on the government's plans to stabilize the property market and address the broader issue of corporate debt. The Evergrande crisis also highlighted the challenges of assessing risk in emerging markets, where information asymmetry and a lack of transparency can obscure underlying vulnerabilities. This realization led investors to demand higher risk premiums for investments in emerging markets, increasing borrowing costs for companies and governments alike. As the dust settled, it became clear that the Evergrande crisis had left an indelible mark on investor confidence, prompting a shift towards more cautious investment strategies and a greater focus on risk management. The road ahead for emerging markets, particularly those heavily reliant on Chinese investment, promised to be fraught with challenges as investors grappled with the fallout from the Evergrande saga and the implications for future growth.